I can hear you.
Great. Hi, everyone. It's great to see you today. What a week we have chosen to talk about American economic outperformance. But if you can, I would encourage you to use this opportunity to step back a little bit from the events of the last few weeks and think about how the US and the UK have fared in terms of productivity performance. You'll know that the UK performance in the 2010s was pretty dire, second worst in the G7, and in the first half of the 2020s, official figures say it had an even lower growth rate. Obviously, productivity is output per hour, and so our measures of productivity are only as good as our measures of hours worked. And here at Resolution Foundation, we have some skepticism about the official measurement of employment and hours at the moment. And so if you take that into account, unfortunately, it means productivity has been even worse than official figures would suggest. On the other hand, the US is pretty unique in the G7 in terms of its outperformance since the pandemic. So what we wanted to do in our report today is delve into both what's happened in the US and the UK and see what we can learn from comparing the two, particularly in trying to improve the UK's outperformance. And particularly this week, I am extremely grateful to our panel for making the time to join us. Clare Lombardelli, Deputy Governor at the Bank of England, former Chief Economist at the OECD and Chief Economic Advisor at the Treasury. And online, Jason Furman, Professor at Harvard's John F. Kennedy School, non-resident Senior Fellow at the Peterson Institute and former Chair of the Council of Economic Advisors under President Obama. Advisors to presidents and chancellors and governors, so we should be able to crack this problem. But before I turn to Clare and Jason, no pressure, Simon, but my challenge to you is tell them something they don't know about US and UK productivity.
All right. I'll do my best. Thanks a lot, Ruth. And I'd also like to extend my thanks to Clare and Jason for joining us today. It's a real privilege for me to be part of such an amazing panel. With that in mind, I don't want to take up too much time away from my fellow panelists, but I'll just give you some background to frame today's discussion based on the research that we published earlier today. So starting with the basics, this is an index of labour productivity in the UK, or GDP per hour, going back to 2018, according to the ONS's official data. And they think that productivity grew by 1.8% from 2019 to 2024, which is not very good. Back before the financial crisis, we averaged about that much productivity growth every year. So given that we've had that over 5 years, that's about a fifth of the rate of growth that we used to have. And as Ruth mentioned, it's even a slowdown from the 2010s, which themselves were not very good. So it's about 2/3 of our 2010s average growth rate. So that's the bad news. There's some even worse news. And the worst news is that, as Ruth mentioned, these official stats are based on the Labour Force Survey. I'm sure most people in this room have had chapter and verse on the issues with the Labour Force Survey in recent years, so I won't go over those, but the important thing to know is they are probably understating the number of people in work right now. And my colleague at RF, Adam Corlett, has done some brilliant work over recent years, over the last year really, to estimate employment from administrative tax data, which we think is the most reliable source of data on employment in the UK right now. And a stronger recovery in employment that data suggests means weaker productivity. So on our preferred measure, in the dark blue line here, productivity has fallen by about 0.5% between 2019 and 2024. That's not totally unprecedented. So around the financial crisis between 2007 and 2012, productivity fell by 0.6%, so a little bit more. But it would be historically the kind of second worst 5-year period before the pandemic. So really not very good in terms of UK history. But if we look across countries, and we look in the G7 in particular, the UK isn't alone in its recent struggles. So Canada, France and Italy have all seen labour productivity fall below its pre-pandemic level. But there is a conspicuous outlier on this chart. And it is strange to be putting the US up as a shining example for other economies to follow, given what's happening in the world right now. But they really were exceptional in the first half of the 2020s when it comes to productivity growth among big high-income countries. And so in the paper, we take a look at what explains the gap between the US and the UK, and that divergence in their productivity growth in recent years. So I won't give you all the details. If you want those, take a look at the paper, but I'll give you kind of 3 key things to know. The first thing to know is that oil and gas has played an outsized role in explaining the divergence in productivity growth. So the red lines on these charts are US output of oil and gas, and the blue lines are for the UK. And as you can see, very, very different trends going back over the past 20 years, and those trends have continued into the 2020s. And at the same time, hours worked in these sectors are quite sticky. So this feeds through to kind of trends in productivity. And these trends are so starkly different that even though mining and quarrying is quite a small share of the economy in the US and UK, less than 2% of GDP in both countries, it accounts for a sixth, or about 16%, of the recent productivity divergence between the US and the UK. But actually, outside of mining, most of the US's growing productivity advantage has been concentrated in services rather than other goods-producing sectors. And when you think of US services, some of the most high-profile names are in the tech sector. So big companies like Meta, Google, and Apple. In the paper, I call these the tech-producing sector, or the tech-producing companies. And it is indeed true that in recent years, the US tech-producing sector, or the information and communication sector, has outperformed the equivalent sector in the UK in recent years. And that's part of the story. But what I do highlight is that it's tech-using sectors, so the companies that are consuming the products of companies like Apple, Google, some of the frontier AI companies as well, where there seems to be, they're playing an even bigger role. So to give you an example, the professional services sector, which covers everything from consultants and lawyers to architects and engineers, that accounts for twice as much of the US-UK productivity gap as the information and communications sector. And it's not just professional services either. So the US has outperformed the UK across a range of key service sectors, including less glamorous ones like wholesale and retail trade. So that's another key part of the story to bear in mind. And finally, I just want to leave you with what to do with this information. So the sectoral pattern that I've kind of described is consistent with 2 things. So first, it's consistent with a concentrated investment slowdown in UK professional services that occurred around the Brexit referendum. And it's also consistent with a kind of partial revival in business dynamism in the US that is again concentrated in services. So for UK policymakers, this is a really good reminder that they should be focused on these 2 issues that are harming UK productivity growth. And in the paper I talk about there's some tweaks you can make to the tax system that would be fairly cheap and growth friendly to kind of boost investment and boost dynamism. And then we should also be thinking very seriously, especially with what's going on in the global trade system right now, about taking as much advantage as possible and exploiting opportunities for free trade with some of our key trading partners. So yeah, with that, I will leave it there. Thank you very much.
Thanks, Simon. Claire, over to you. What do you make of the comparison?
Great. Well, look, thanks very much. Thanks for inviting me. It's lovely to be here, and congratulations, Simon, for some great analysis by the Resolution Foundation. I mean, it's really good to be talking about productivity. You know, it is ultimately sort of the most important thing in terms of driving economic welfare. You know, we all know the Paul Krugman quote, it's not everything, but in the long run, it's almost everything. That is completely true. It matters to obviously everyone who's doing policy making. In terms of how we think about it from a monetary policy perspective, it plays in terms of thinking about the supply side relative to demand, the kind of amount of resource pressure in the economy, which is about how much the economy can produce, and of course the role of that in setting prices. Now I'm hoping, we've got some slides. Okay, I'll try not to repeat too much of what Simon says, but obviously it's the similar story. I mean, obviously, let me just start and talk a little bit about data and definitions. We think about productivity broadly, the amount of output you get for a given set of inputs. Economists do output per hour or output per worker. It's quite hard to know, I would say, right? The data is difficult, and it's just quite intrinsically difficult to measure productivity because it's intrinsically quite difficult to measure output, if you think about particularly very heavy services-led economy like the UK, services can be quite difficult to measure, particularly where they're not priced. The obvious example everyone always gives is Google Maps. That obviously is increasing productivity in lots of ways. It enters the statistics nowhere. There's also a question about quality and how you measure quality. A car today is a very different thing to a car 30 years ago. How do you factor that in? And then, of course, the other area, and we'll touch on this a bit, is the public sector, and how do you measure output in the public sector, where actually the UK is quite forward-leaning in the way it measures output by measuring the amount of things that happen, whether that's appointments, operations, hours teaching, those sorts of things. Of course, there's a sort of well-known sort of effect of what happened there during COVID and beyond the period that we're talking about here. But of course, that really matters. So you've got an intrinsic challenge of measuring the output. And then, of course, as we know, there's current statistical challenges that you've mentioned and talked about, both on the labour market side, but actually also on the GDP side. So in both senses, it's just quite hard to know. The other thing I would say is the data is very sensitive to the years and the time period that you choose. So in talking about the post-COVID period, quite how far you go, if I'd have cut these data slightly differently, it'd look slightly different. So I'm talking today about kind of broader points. What I'm showing you here actually is a very long run picture. You have to indulge me, the economic historian in me loves doing this. If you take productivity in the UK and the US back to the 1800s, what you see here is actually for most of the 19th century, the UK had slightly higher productivity, but they were very similar. That was, why people sometimes call it the British century. After 1900, you see a much greater increase in productivity overall, and that is technology and technological adoption driving that. You also see from about 1900, the US overtaking the UK, and that trend has pretty much continued and widened, as you can see here, and that's why, this was the 20th century is considered sort of American century. A point that Simon made, but I would really also emphasise here, is that the outlier is not the UK. The outlier here is the US. So all large advanced economies have seen more stagnant productivity over a longer period. You can see here I've plotted this from the 2000s, but the picture is broadly the same. The outlier is obviously the US, which is the orange line. The UK you can see is kind of in the middle, though, actually, so it's not particularly bad. We can have a conversation about the post-COVID period, but really the session is about the comparison of the UK and the US, but actually I think really you could say it's about the US and other advanced economies, large advanced economies in particular. So if you look on the left, you can see that the US is, I would say it's really worth pausing on how remarkable the US is. So generally when we think about growth, we think about the sort of convergence, that as economies become advanced economies, their growth tends to slow and they tend to converge. The US is not doing that. I mean, if you look at this, it's grown twice as fast over that since 2000 as the next nearest, which is Germany on this chart. That is actually quite remarkable. If you look on the right-hand side, what I've done is I've basically divided this period into three periods, which I think is worth doing. So you've got the period before the GFC, before the financial crisis. You've got the sort of following 10 years, and then you've got the post-COVID period. And it's quite a different story across those periods. In general, productivity has trended down across that, and you can see the US again being the outlier there. What you see across all countries is high levels of growth before and up to the global financial crisis, high levels of productivity growth, and then that tailing off. And as you can see from this chart, the period for the US post-COVID is quite remarkable compared to others. I'm going to talk about investment a bit. I mean, there's lots of determinants of productivity. So the amount of capital in an economy is obviously a really important part of this. There's also the quality of labour, the skills, the education level, and then there's sort of TFP, which, does sort of everything else, but that includes, how we allocate that labour and capital, which I'll come on to talk about a bit, technology, things like institutional setup, cultural setups. But I do think it is worth pausing on investment for a couple of reasons. I mean, here you can see investment since 2000 across sort of G7 countries. The UK has a relatively low level of investment, particularly private sector investment. You can see here it's on the left. And this is really critical. If you think about it, it's just how much capital you wrap around every worker is going to be one of the key things that determines their productivity. The other thing that you can sort of see from here is actually you're not seeing a lot of crowding out, in the sense of, high levels of government investment is not sort of correlated with low levels of private investment. You see a roughly the same sort of trend. Okay. Let's talk about the sort of sectors. I think if you look at the sectoral breakdown and the sort of contribution of each sector to productivity, you can begin to get a bit of a sense of some of the story here. I mean, I do want to pause and talk a bit about reallocation. So how labour and capital are allocated across the economy is obviously critical to driving productivity. I mean, if you think about economies as basically machines for allocating resources to their most useful outcome, the US is just extremely good at that. Right? It is extremely good at getting the most out of workers, the most out of capital in this way. People move between jobs, they move between sectors, they move geographically an awful lot. Similarly, capital moves around, it attracts very high levels of capital. And so you just have a much more dynamic culture, a very different attitude to risk. So there's a much greater dynamism to the US economy. I mean, we have to recognise there are wider consequences of that. Right? So this is a sort of a choice in a way about how you countries are sort of run, and the distributional implications of that, something to sort of think about and pause on. But that is really what is underpinning a lot of what we see in the US, this dynamism by which resources are moving to their more efficient use much faster than other advanced economies. And this is basically at the heart of many public policy choices, right? How fast do you want that process to go? What is the consequence of that? What is the distributive sort of implication of that? But look, if we break down productivity growth into the contribution of different sectors, which is what this chart does, if you look at the first block for each, for the UK and the US, what you see is this very strong period of productivity growth we saw before the GFC, and this is strongest in manufacturing, right? And you can see that's the sort of blue block here. It's large in both. And actually, that is really noteworthy, particularly if you think that both the US and the UK are very service-heavy economies, but you've still got this much bigger contribution coming from manufacturing during that period. And you've also got big contributions from services in both of these. And what this is, broadly, is the adoption of kind of technology and the sort of rollout of IT and IT across both manufacturing and services. And of course, what you would expect there is a big sort of step up in productivity, and that is what's going on through this period. And of course, you can only really do that once. So you can only turn a production line from being, humans doing it to machines doing it once. You can only replace your booking system with an online system once. You can only replace your till with an automatic cash desk once. So you would expect actually to see this sort of big increases in response to that. And of course, that's what's going on here. I mean, there's also a discussion and a debate to be had about the sort of overhang from the GFC itself, but really a lot of this is about technology and the movement there. And then if we move on to see what actually the differences are, if you look at the final block, which is what the sort of question we're looking at now, which is the post-COVID period, you do see a much higher level from the US than in the UK. And there's a couple of things you see. You see a very big increase, and Simon touched on this, in productivity in informational and professional services. So you can see that in the purple block here, much higher for the US. If we'd have separated out the tech sector, you would have seen a much bigger increase there as well. I mean, technology in the US, really driving an awful lot of this change. The other thing you see is for the UK, you've got this negative block from other services, and in part that will be about what's going on in the public sector for the UK, which is a sort of drag on productivity, and we see that in the data. Just pause a bit on looking at this comparison. I think it's really important that we recognise what we're talking here about is measured productivity, right? And I draw that out, and it is different in a sense. So I would divide that into two things. You've got the structural productivity, what we normally think about as productivity, the issues that we've been talking about, the allocation of resources, technology, those sorts of things. And we know that the US is very good at that. Very good at reallocating resources. The other thing, though, for this period is you've got a cyclical effect, and that's been really strong, right? For the US in particular, this has been a very large factor through this period. The two things I would draw there, one is just the strength of demand, so consumer demand, investment demand, government demand. In the US, that has been really, really high through this period. And if you think output per worker, right, output has just been higher because of that. And you've seen less labour hoarding. That's been a particular thing in the Euro area, but we've also seen some of that in the UK through, if you think about the whole period post-COVID. So in the US, you've had much stronger demand that's been driving up output. The other thing which Simon also touched on is the energy shock, which has just played through really differently across this time period. The US is an energy exporter, the UK an energy importer. That's been a much different sort of set of costs that have hit the UK, and that's affected output too. So you've got a mix really of cyclical effects through this period and structural effects. We should talk about the structural effects as the thing that affects long term. But look, I'll just conclude. In terms of lessons I would draw from this comparison, there's a few I would say. One is just the importance of economic dynamism, right? The norm in the US is just much more movement. I take no judgment on what the right level of economic dynamism is, but that is a sort of debate and a discussion, and as I say, a question for public policy. There are a set of sort of cultural factors. We sort of, economists are increasingly understanding the importance of things, the attitude to risk-taking, the attitude to what is failure, those sorts of things, quite different in the US. It is very important what happens with investment. The UK has a very long-running, low investment economy compared to other G7 economies. That will make a difference, and that's particularly around the adoption of technology, the diffusion of technology. There's a whole set of issues we could discuss if we had more time about firm size and how that happens. The other thing I would say you can draw out from this is the importance of services. Both the US and the UK are service-led economies, and the US has shown you can get really big productivity gains in services, and that is what would drive productivity in the UK. It's a very service-based economy, so looking for more gains from services is something that could deliver a lot for the UK. And then the other thing I would say is this is only part of the picture when we think about productivity, right? There's lots of lessons that we know from economic history, from economic theory about what other things drive productivity. And so, there's a lot to learn from the US, but I would say there's quite a lot to learn from other countries and looking at this more broadly. But I'll stop there.
Great, thanks so much, Claire, really interesting. Jason, let me hand over straight to you, and we will load your slides up, and it should all work well. And I will
keep filibustering in the meantime.
Great. Well, Ruth, thanks so much for including me in this. I would love nothing more than to be in London with all of you rather than here where it's cold and rainy. Might be cold and rainy in London, who knows? I'm slightly worried that this is like the famous phenomenon where if a business person is on the cover of Fortune, they lose their fortune shortly after, Sam Bankman-Fried and Elizabeth Holmes being the most famous examples. We also see it with athletes that are on the cover of Sports Illustrated, all of whom do worse in sports after than they did before. Broadly, there are two types of questions that people in the United States have been asking about productivity. One question is just what is it going to be over the next decade, over the next decades? And that's a prediction exercise, obviously conditional on a certain view of what policy is. And it's an important one to inform debates, for example, about the federal budget and fiscal sustainability. Policymakers need to know what growth number to plug into their forecast. And so an awful lot of debate has been on that question. Obviously, there's another very important debate, and it's the question and topic that has largely this panel has been focused on, which is what can you do about productivity growth? What can you do if you want to increase it? We can go to my first slide. Most of these are things you've already seen basically before, but there's just no limit to how often one can look at this slide, and you could replace Euro area with UK, and that chart on the right would look the same. Going into the pandemic, there were very different trends in terms of productivity growth, 1.8 and 0.4. Coming out of the pandemic, the United States has had the same or faster productivity growth than it had going into the pandemic. Europe, if anything, has had the same or slower productivity growth than it had going in to the pandemic. And Claire told a nice story about how this post-pandemic divergence has been even bigger than what went into it. The one place where I see it a little bit differently is I don't think it's just about demand. The United States has had more demand, but if you look, interestingly, output rose more quickly in the United States than it did in Europe or the UK. Employment returned a lot more slowly in the United States than it did in the Euro area and the UK. We saw a much bigger reduction in employment rates, and then it took longer to get those employment rates back. And this is where I think I'm now going back to agree with Claire that this dynamism and reallocation had sort of two flip sides of it. One was there was a more prolonged period in which people were out of work and separated from their jobs. But on the flip side of that, that led to more reallocation and better productivity coming out of it. All of which, by the way, I think should lead to some rethinking of the whole concept of hysteresis. The idea if you're separated from your job, you lose the ability to work, you lose productivity, you lose the ability to connect yourself to a new job. We had much more separation from jobs in the United States, but the productivity was actually better, and it might have been better because of that separation, not despite that separation. So there's some, I think, interesting nuances and stories that one needs to return to in that regard. Next slide. The United States, some of the debate has been, are we in a new era of productivity growth, or is this just sort of the same normal that we were in? And, a year and a half ago, there was a view of, oh, look at this incredibly rapid productivity growth. AI is working out. We're in a whole new era. It's the inflection point. But at the time, to me at least, it seemed reasonably clear that what we were seeing was bounce back from the negative productivity, that at least in the short run, the numerator and the numerator being output, the denominator being employment, have almost their own dynamics and their own determinants. And so productivity is the residual. It's only a good measure of innovation over a longer time period. If you go to the next slide, to a first approximation, the United States had these large residual movements around demand returning before workers returning, so people having to work more intensely, then the opposite. But now it's back uncannily on almost exactly the forecast that one would have expected 5 years ago, which is why I have been skeptical, at least based on backward-looking data, that one should raise the US productivity forecast. And then the next slide. And this puts the current recovery in context. It's been 1.8% per year productivity growth. That's better than where we were in the decade after the financial crisis. It's still a little bit below the long run rate, and it's quite a lot below. This shows it by business cycles, but if we called out 1995 to 2005, the dot-com / increased utilization of information technology, the latter being the more important factor, we're still a decent amount below that. What does that suggest to me? The Nick Bloom et al. Hypothesis of running out of ideas to me feels even more compelling than it did before. That basically there's this race of we have better ways to discover things that could be AI, CRISPR, and other tools that we have now that we didn't used to have, but we have to discover harder things. We already figured out the easy ways to deal with cancer. Now it's the hard ones that are left. We already made all the obvious improvements in productivity in the agricultural sector. Now we're trying to figure out how to pick raspberries and blueberries. That requires an enormous technological marvel, huge technological inputs, but the output isn't quite as good. So in answer to the first question for the United States on what should we think about productivity growth going forward, I realize most other advanced economies would be thrilled out of their minds to have 1.8% per year. I think that's a perfectly good, perfectly happy place to be going forward. But in some respect, that is a productivity growth rate that's closer to the sort of new normal that people had been disappointed with in the post-1973 period than it is with the excitement of the dot-com. You can pull my slides down because the rest of what I'm going to say is not off of the slides. So, what might be different going forward? There are one shock that hasn't worked its way through the system, which is artificial intelligence. To date, I wouldn't even be surprised if that has lowered productivity, not raised it. That's because of a J-curve-like effect of you hire people to figure out how to use the AI. They're not making stuff in the short run, so output per hour goes down, but then in the long run, they figure out how to use it and output per hour goes up. So I think we're not just early in AI, we're early in understanding the deployment of it. One open question internationally and for comparison is how important is it going to be the country that makes the best foundational models? That's something that you see right now in the United States and China and basically no other place. I think it is perfectly plausible that foundational models become like a commodity. They all do roughly the same thing. They means they end up pricing at something like marginal cost. It turns out that the stock market was more excited about them than it should be. But to think about innovation and macro effects, it's how they're applied and used, and that gets more dispersed and used around the world. So the whole who will win the AI race might have been the wrong prism for this, when first of all, ideas spill across borders, and second of all, foundational models aren't the same as the ways in which you're using them. Then there's the policy context, and I think in talking about the United States, it's impossible to talk about that. And to some degree, the lesson for the rest of the world is to do the opposite of what you're seeing us do right now. Immigration is absolutely critical to productivity. It's been a central part of American productivity. Most of the great ideas powering our economy are not most, many of them come from immigrants, and immigrants also make people who are here smarter. We are reducing that. Trade is very important to innovation. Most of the trade models that people look at are basically comparative statics. They ignore innovation and just look at how patterns of production and employment change in response to trade. But trade both shifts out the innovation production function by allowing greater movement of ideas, greater specialization, and it also increases the return to innovation by increasing the scale of markets and also by increasing the amount of competition. And no matter what the United States does with tariffs over the next 24 hours or over the next 3 3/4 years, the evil genie we have unleashed in terms of tariffs and uncertainty will continue to affect global integration and specialization for the United States. There is research and development, especially in the biomedical space, where the United States has been a real leader and is making dramatic cutbacks to what it is doing in that space. Finally, there's the issue of competition and regulation. This one is quite tricky. You, in some sense, don't want to be overbearing with competition because you want companies to be able to innovate in order to get the fruits of what their innovation is. Some of that fruits include a period of monopoly profits. But on the other hand, there's this set of arrow arguments, which I think are very compelling, about the importance of competition for innovation. Otherwise, monopolists would be fat and lazy. I have had every opinion on this issue one could possibly have. I was honored to chair a panel for the UK government on the issue. I think more competition, more pro-competition regulation, like the Digital Markets Unit that the UK set up, is really important and really good. But I have been somewhat impressed that AI has brought more competition than I expected. It's not just that Google could take advantage of its position and scale to be the best at AI. It was new companies that did. DeepSeek did it with an even smaller capital base. And so AI might end up proving that it's the algorithm that matters more than the scale. Finally, I'll conclude by saying I think part of the divergence we've seen between the United States and other countries is that we are now in a phase of the economy where scale matters more than it has before. That's true in the digital space with digital platforms. It's true in the digital space with artificial intelligence. It's true in finance. The United States has extraordinary scale. China has extraordinary scale. Within the European Union, two of the places it's most behind are on digital markets union and capital markets union. And of course, the United Kingdom isn't part of the European Union anymore, and so is going to need to figure out other ways to get to scale in a world where it's a very important, very exciting, but still medium-sized economy. So figuring out how to increase economic integration globally is even more important in a world where the central innovations require scale. And thank you for listening to that.
Thank you so much, Nathan.
I'm glad you acknowledged, Jason, that it must be nice to be having a debate about whether to upgrade the trend productivity rate. That's not quite the debate we've been having in the UK. If people would like to ask a question online, I will try to bring a few in. I think it's #OwnLeague with a capital O and a capital L. But we will also take questions in the room because it's great to see so many of you here in person. If you put your hand up, Emily will come with a microphone. Okay, we've got some already, so let's give it a go. Should we do one at the end and then one at the front, Emily?
Thank you. So I found it interesting, Claire, that you said about diffusion. What is it that the US does better at diffusing technologies? Like, what institutional frameworks are available for that? And how do you think that intangible kind of technologies is going to impact that diffusion?
Great, we'll take a few because, yeah.
Can I just ask about rates of return on investment, whether or not that helps explain, returns to innovation, and maybe they're rather different, say, in the US than in Europe or the UK specifically?
Great, thanks. Let's take one more because we don't have ages.
Hi, sorry, Phil Aldrich at Bloomberg. Can I go a little bit off topic and ask Claire about tariffs?
Looks like you're going to.
I just wondering, Charlie, who's here, as Charlie Bean, who's here, has said he's recommended a 50 basis point cut. Others on the committee seem to be talking about disinflationary effects of the tariffs. I just wondered whether your reading of it is that the tariffs are disinflationary, Claire.
So we've got a question on diffusion of technology, a question rather predictably on tariffs, and a question on rates of return on investment. And Jason, I know you've written about tariffs as well today. Can I come to you first because that'll be a bit easier with the tech? Which of those do you want to pick up on?
Sure. I'll do tariffs and rate of return. I mean, from the US perspective, this is partly a supply shock and partly a demand shock. The demand shock coming especially from the effects that it has on confidence and uncertainty. What monetary policy should do in the face of that, I think, is unclear. But I'm concerned that we went into this with a 2.8% core inflation rate, with inflation expectations elevated, they've risen more, that we're likely to see it show up in the price data before it shows up in the output data. And so the Fed probably needs to be, one, more reactive wait and see than you would like a central bank to be, not being proactive and getting ahead of it because you don't know how the data is going to bounce, and two, more likely to keep rates higher than I think a lot in markets are counting on right now because of the sequencing of what that data will look like. How do you cut rates in a world where you have a 3.5% inflation rate that is projected to go higher? I'm not an expert on the UK at all, but there you have both supply shock and demand shock. But I would think the ratio of the demand shock to supply shock is higher than it is in the United States. And so the argument more unambiguously for cutting rates faster than you otherwise would have, is stronger than that argument would be in the United States. But I say that with a lot of humility. On rates of return, I think one really interesting question there is going to be that a lot of that U.S. innovation happened in a world where the equilibrium interest rate was really low. And so you could have some, crazy idea of setting up a brand new rocket ship company or a brand new, AI or whatever it is, not going to have returns for 10 or 20 years. You discount that back to the present, and that investment would be justified. We're now in a world where the equilibrium interest rate has shifted higher. And so, and a lot of people think that's good. We solve secular stagnation. We now are in a world of higher interest rates. But I do wonder what that will do to risk taking. And in some ways, that's good, less risk taking in financial markets. But in some ways, that's bad, what it does to the risk taking associated with innovation. And on diffusion, I have no idea the answer to your question, so I'm hoping someone else does.
Claire, do you want to pick up some of those
Yeah,
questions?
sure. Well, look, let's start with the inevitable question about tariffs. I mean, look, to bring it back to the topic of today, I would say, as Jason says, completely agree with Jason that trade is obviously good for productivity and is good for growth. But in terms of thinking about tariffs, I mean, obviously at the moment what we're seeing is, a change in US trade policy, potentially a change in other countries' trade policy. In response to that, we're seeing an increase in uncertainty. We're seeing some changes in asset prices. We will obviously bring all of that together and think about all of that for the next policy round, and we'll think about the impact on UK activity, the impact on UK pricing. I think the effect on activity, you can expect that, particularly, we know the tariffs are likely to depress activity overall. The uncertainty, the combination of those sorts of things will the direction there is relatively clear. On inflation, it depends a lot more on the circumstances of actually how other countries respond, how that feeds through to the UK. But we'll think about all of that together for our next decision in May. I'm not going to take a position now on what that means for the precise level of monetary policy. On just to come to the question about diffusion, I mean, you asked about sort of institutional setup there, and actually I think it comes a bit to what I was saying about the private sector and private sector investment. I mean, the US has sort of very deep capital markets. A lot more capital available there. I'm not sure the answer you're looking for there is a kind of institutional one. This is much more about the availability of capital, the attitude to risk, the attitude to investment. But it's clearly the case, and there's a lot of evidence in the UK that the UK doesn't have a problem in terms of being at the frontier of technology advancements. I mean, you've got Jason's point that actually, in a way, it doesn't matter who invented it if you want to adopt it. But there is also lots of sectors where the UK is right at the forefront of thinking and the technology frontier, where we've got less of a strong track record is on diffusing that across the economy and across firms, and in particular across firms of kind of all sizes. So you do see a real difference there. As technology advances, you would expect that to play a sort of larger and larger role.
And I think the question mentioned intangibles, and I was pleased that you mentioned measurement, Claire, in your remarks, because we had Diane Coyle here last week on her book, and the problem with reading her book, although I do recommend it, is that you do slightly lose faith in the usefulness of GDP as a measure of particularly productivity and living standards. So that was a good sobering event to have before this. Simon, do you want to come in either on the link between tariff and productivity? And I know there's energy came up in both Jason and Claire's remarks as well, and it might be worth picking out a bit more of what we said in the report on that.
Yeah, I can do that. I'll also touch on the diffusion question. So people often think about diffusion as like ideas somehow catching on between firms. So firms who are lower down the productivity distribution somehow learn from firms at the top. But another way you can replicate that is just by having more dynamism. And so the firms who are at the top, who are the most productive, are able to outcompete less productive firms and take their market share, expand. Low productivity firms got a business. So that's, I think when you're thinking about diffusion, that's one thing to bear in mind. And there's things that we have in the UK that are not well set up for that. So I talk in the paper about the VAT threshold, which is I think £90,000 now, which is basically an incentive for small businesses to not grow and gives them some level of tax relief, or at least relief from engaging with one part of the tax system. You know, you could cut that threshold quite a lot, and then you remove that break on firms. We suggest you could reduce it to 30k, and you've moved a break on firms with turnover between 30 and 90k. So that's the sort of institutional changes that you could think about if you wanted to get something that looks like better diffusion in the UK. On tariffs, so you know I'm thinking in terms of the long-term impacts on tariffs on productivity. So as Claire says, and Jason says, there's sort of short-term impacts on demand that are very relevant for the inflation outlook. But over the longer term, the direct headwind from tariffs would be that there are these complex global supply chains that involve intermediate goods moving across many countries. And if we move into a world of not just the US applying tariffs on other people, but people retaliating and then potentially, trading blocks forming, people going against China, if all the Chinese exports that used to be going to the US are kind of flooding others' domestic markets, those supply chains might need to be broken up and reworked and potentially to less efficient versions of their former selves. And then the second, more indirect outcome and the impact on productivity would be from higher uncertainty. So if we're just moving towards a more uncertain world, that's really bad for investment. We know that from lots and lots of evidence over time that the higher the level of uncertainty is in the world, the more reluctant businesses are to invest. And so we know that investment's been a big headwind to UK productivity, so that could get worse over time. On energy, so this was a kind of a bit of an interesting one when I was writing this paper. So I came into it quite convinced that energy was going to be a big part of the story and was expecting to see, UK lagging quite significantly behind the US in energy-intensive sectors like manufacturing, transport, construction. And with the exception of mining and quarrying, which I talked about earlier, which is a bit of a special case, it's actually the less energy-intensive sectors where the US has outperformed the UK. So that for me was a bit of a puzzle. I think it made me downweight potentially my guess of how much energy was playing a role, and it could be that the US and the UK are both service-led economies, and the manufacturing they do is quite high value, not so much energy intensive. And so in the short term at least, it doesn't seem like energy is like a massive part of the story, but I'm very much open to being convinced otherwise on that.
Great, thanks, Simon. Let's take a few more questions if people have them. One at the front here and then one back there. If that's easier. Ignore my order.
Thanks. Yeah, just to Claire's point on reallocation and specifically around COVID. From Simon's chart, like UK and US productivity both spike, largely the denominator effect, and then UK productivity falls back and US productivity doesn't. How much of that do you think was driven by divergent macro policy response to the shock of COVID? And I mean, the UK focused on existing firms, the US focused on people, bluntly. So what lessons does that point to for future sudden significant shocks like that?
And let's go forward. So we'll do Tim and then the gentleman at the front.
Thanks to Claire for raising economic history, and my question relates to that. In the post-war era, we know that a lot of US economic growth relative to Britain was driven by a much more open planning system and much more investment in things like roads. That allowed the US to move to scale in logistics, massively raising productivity. And I wonder, therefore, whether we could be more optimistic about Britain in the context of planning reform. Will it allow firms to get to scale in those sorts of service sector industries in the way that the US has done for the last 50 years?
Thank you. I'd like to hear a bit more from Jason, please. The Peter Navarro policies on trade. why you think that would, just flesh out a bit more, why it would impact US productivity going forward. If you could highlight a few of his key proposals and how you think they affect US productivity. Thank you.
So Claire, maybe I'll come to you on the role of different macro policy through the COVID period and what that might have played, and also anything you want to say on planning. And then Jason, just to check you could hear the questions, we'll come to you on Navarro, and also it'd be interesting to get your perspective on whether you think either the different policies during COVID have played a role here, or the later subsequent divergence in kind of fiscal policy. Claire, should we come to you first this time?
I think it's a really interesting and important question about COVID, the macro policies of the time and the consequences of them. I think Jason makes a really good point about actually should we does this mean we should rethink hysteresis? And I think it does. I think, I'll be frank, my view on this is an area that needs a lot of research. Okay, in COVID, new tools were pulled, right, for policy that had never been used before. There was very, very good reason to do them, and perfectly sort of well thought through response. But we have a lot more information now. We didn't have any of this information at the time, and so I would, if I was studying economics now, if I was thinking about doing a PhD, if I was doing research now, please, people, this is a really rich area of research. I think a lot of people should look at it. There's a whole host of different schemes, a whole host of different tools. There's a lot of very interesting comparative analysis you could do across country, not just looking at the labour market tools, actually look at some of the business support and all of that. And I think it would be really well worth some investment in that, so that should we face a similar sort of shock, or actually other sorts of situations in which you're thinking about the role of reallocation versus keeping people attached to their jobs and those sorts of things, it's an important area to look at. But it is clearly part of the story, as Jason said. What you saw in the US was people being separated for a period from their jobs and effectively reallocating, both within sectors and across sectors. And there's a question, did that mean when we had that period of very, very tight labour markets in Europe, and this is a Europe-wide phenomenon, was that experience different? So I think a really rich seam of research. I mean, I think you should also bear in mind there are quite big cultural differences between the sort of US and the European approach to these things, and in a sense a kind of different welfare function that people are maximising. But I think a really important question, and I think it is incumbent on all of us to make sure we take the time and the space to learn the lessons from that. On planning reform, I think there's a lot of reason for optimism here. I think it is obviously the case that the UK is geographically quite constrained in terms of the amount of land it has available. The issues with the planning system are very, very well known. So medium, long term, I think that could unlock. It comes back to this point about reallocation, right? And are we using our sort of very constrained land resource in the most efficient way? Planning reform has to help with that. I don't think you will see it could take some time before you see the full benefits, but there's real potential there.
And Jason, can I come to you?
Yeah. So there was a tariff question somehow that's all my brain can think about. There was another one I thought was interesting there.
What role did different policies through COVID play, and then perhaps also subsequent fiscal policy?
Literally, that was what Claire was just talking about. It shows you how fertile my brain is. So yeah, I completely agree with Claire's main conclusion on that, which is that more research is needed. And just as a side note, cutting edge academic research tries to find answers it can give a precise questions that it can give a precise answer to. So everything is the same except you change one thing. Here, the only answers are going to be from comparative research, studying the United States and UK. There are a million things that are different between the United States and UK. You're going to have to use a certain amount of judgment about which of those differences are important, which of them are not. So this is the type of research that I think is actually better done by places like the Resolution Foundation, your former employer, the OECD, Claire, and elsewhere. And doing those comparisons, I do think trying to look as much as possible through the end of 2021 is the better way to do it. By 2022, you have the Russian invasion of Ukraine that has enormously disparate impacts on countries depending on whether they're producing their own natural gas or needing to import it, and the degree of trade relationship and other economic integration they have with Russia. So that was just another huge shock in 2022. But my tentative conclusion, which I'm open to updating, is that the employment retention schemes worked better than I would have thought. That I previously, in the context of the financial crisis, thought maybe this is something that works in Germany because they have a very specific institutional structure for their labor markets, labor unions, and the like, but you can't just graft it onto the United States. I think the UK is institutionally closer to the United States than to Germany. You stood this up for the first time, and my impression is it worked quite well on the employment side. Then with less confidence, but a certain amount of trepidation and nervousness is, did that mean less reallocation and hurt on the productivity side? And so was there this trade-off that I talked about before? But everything I just said is speculative, except that more research is needed. On tariffs, broadly, there are a multiple set of contradictory visions that dominate, that are swirling around in the administration. Peter Navarro, though, has a very consistent vision, and it's one where the United States will make more of what the United States uses. And so we are importing less, and the flip side of importing less is that we're also exporting less. That to me looks closer to what the president's vision is, but who knows which direction the president's going to end up going, but that's certainly where he is right now. In a world like that, you have a smaller scale that you're operating on. So take the iPhone. The iPhone is right now produced globally and consumed globally, and it's the same device you see affluent people at least using, no matter where you are in the world. We could have a different world where there was a European phone that was used in Europe, but not used in the United States and China. There was a Chinese phone that was used, and there are some right now, that's used in China. And there's an American phone. And you have 3 different operating systems for these phones. You have 3 different supply chains for the components and assembly. You have 3 different companies that own these phones. And that's a perfectly viable world. There's no reason you need the same thing for everywhere. But that's a world where your scale is smaller. And your scale is smaller means you're going to have less innovation. You're going to have less diffusion of that innovation. And what that means is less productivity growth. So smaller scale markets, less competition between markets, less learning by doing, less specializing and getting really, really, really good at one part of the supply chain. All of that is what, moving in the direction of autarky, and we're not anywhere close to it, but we're moving in that direction in the United States. Maybe China will move in that direction one day, or maybe it already is. So I think it means smaller scales. And my whole point was that the big benefit to innovation in the United States relative to Europe, I think, has come from the larger scale that we have had.
Great, thanks, Jason. I'm sorry, Simon, I'm giving you a chance to ask one more question. But I should say that in the report on dynamism, which you both sort of mentioned has pros and cons and is clearly linked to this question about COVID, there is this trend that UK dynamism isn't just lower than dynamism in the US, it's also quite clearly declined, and so it does seem to be quite an important part of the story. We'll take one more couple of questions, and I will also bring up our poll because it's late and we could do with cheering up, which is about, we've kind of looked back on history. What do we think will happen in the future to UK and US productivity rates? Will they further diverge, get closer, or stay the same? We'll see if we can bring that up. Does anyone in the room want to sneak in with a final question? Over there at the back. Oh, did I miss one there? Should we take those 2?
Thank you. This is a bit speculative, but you all pointed out that the US is the outlier here, and I just wondered when the kind of possibility of superstar dynamics going on here, where people who want to be the most productive firms are sort of going to the US and operating from there.
And one more. So, Jason, that was a question about whether there are superstar dynamics also at play, sort of between countries. You mentioned the importance of scale. Is that at play in the US outperformance?
So my question is a little more on recent issues about kind of the state cuts or I guess federal cuts within the United States and compared to the UK public sector. And I guess this is just a question for the panel. What do you think is going to be the long-term issues with productivity resulting from kind of minor cuts that the Labour government's doing, along with the major cuts that the US government's doing to state capacity?
Great, nice, easy question to end with. Jason, the relationship between kind of public sector spending and productivity, and Simon, maybe we'll come to you on kind of health and the role that's played, which Claire mentioned, but we haven't picked up. So, Jason, can I come to
you first? So, either of those questions or general speculation about the future, which our poll is encouraging you to do.
Yeah. So, on the future, I guess I think convergence is quite a good reason to believe that it happens, because you can always adopt technologies even if you don't invent those technologies. And so if I were doing a bet on a 25-year time scale, I would bet on convergence. And that was even before the United States was doing its level best to lower its productivity growth down to the rest of the world's. On how it's doing that level best, I think immigration is bigger than public investment, but public investment matters too. Moreover, and this I think links up with what I understand to be Diane's book. I haven't read this one yet, but I look forward to it. Is not everything is measured by GDP. So there's certain, if we don't find a cure to a disease because we cut medical research, that might not actually hurt our GDP very much, but it hurts how long we can live and how well and how healthy we can live. And the direct line, at least in the United States, I'm not familiar with what the Labour government is doing there, is cuts especially to biomedical research. And I think that's going to show up probably more in lives lost, which you can quantify, but doesn't necessarily get quantified into GDP. But the final thing I'd say is that I think it is the case that there's some chance that everything we're talking about here in terms of policy is swamped by the impact that AI has as it gets deployed and used. And so figuring out and getting that right and not interfering with it and getting it wrong, may be, the most important thing that happens over the next couple of years for the next couple of decades for all of our economies.
Great, thanks, Jason. Simon, a word on public sector productivity, maybe?
Sure. So I think in the UK, at least, the Labour government deserves a bit of credit for not cutting public investment in its most recent budget. That's a key way that governments can have a negative impact on productivity growth. And on the second one, the second thing to highlight is one of the issues that I talk about in the paper is that health sector productivity in the UK, at least as measured in the national accounts, has been really bad. And that's like the biggest single drag on aggregate productivity. And that's an area where the Labour government is committed to spending more, which should help. Like I think a lot of the issues in the NHS have been linked to sort of overstretched, just a system that's operating beyond its kind of functional capacity, and that's showing up in some of the productivity figures. So more spending there should probably help rather than hinder. And then to the extent that it leads to better health outcomes for people and people are able to be more productive in their jobs across the economy, that should also help as well. So I think, at least at the time being, it's not a huge amount of blame that you can throw at what the Labour government is doing right now.
Do you want to take a bet on the poll?
Well, I was thinking through so this is the difference between the growth rates, or is it the difference between the levels of productivity? Because that's kind of a key difference. So
you helped us write the questions. So
I did not sign this off. But I think it's just worth acknowledging that the starting point is they're so far apart. So if you believe our numbers, the US has been growing productivity growth of 2% a year over the past 5 years. We've been at 0. That 2 percentage point gap is absolutely like colossal. So even if, you know, US tariff policy remains insane, and the UK kind of gets its act together on a few different fronts, that's a big gap to bridge. So, you know, in 5 years, do I think that productivity growth over the next 5 years will be higher in the UK than it is in the US? I'm not totally sure, to be honest. I think the gap between the growth rates could shrink, but yeah, I think the level will probably continue to diverge.
Thanks, Simon. Very specific. Claire, any final thoughts from you, or thoughts on the US superstar question or the public sector productivity question?
I think, I mean, the superstar thing, there's clearly something in that for the US, and I would say it's not just about firms, but actually also about people. To Jason's point about immigration, that's obviously been a huge... it's driven a lot of the ideas in the US. I mean, at least for now, it is people that come up with ideas, and so that's clearly playing a large role. Yeah.
Great. Well, should we see the results of our poll, and then I will let you all go to your evenings. There you go, shrink. So I'm going to interpret that as people assuming the divergence is shrinking rather than the UK overtaking. But thank you so much, everyone, for joining us. Thanks again to Simon for the report, and to Jason and Claire for joining us. A very topical moment to be having this conversation, but also lots of lessons that we can take here in the UK. Thanks for coming.